Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage Series. My name is Stephen Martin, and I lead Business Solutions at the Risk Management Association. The RMA is proud to make this presentation complimentary to members, and if you're not already a member, you can explore all that RMA has to offer at our website, rmahq.org. Be sure to join us for RMA's Governance, Compliance, and Operational Risk, or GCOR, virtual conference. It's coming up June 7th through the 10th. GCOR will bring valuable content and peer sharing in today's complex environment. We have a lineup of industry experts covering topics such as culture, PPP litigation, climate risk, DEI, artificial intelligence and machine learning, reentry in the wake of the pandemic, and much more. You can see the whole agenda at our website, rmahq.org and /GCOR, GCOR. So today's webinar is the latest installment of the Credit Trends in Commercial Lending, a part of our risk analysis service presented by Tom Cronin and Jeremy Charlson from our partners at AFS. During the presentation, as always, if you have a question for the speaker, you can submit them using the Q&A feature at the bottom of your Zoom screen, and we will get to as many of those questions as we can at the end of the presentation. We've got something special to show you today too. So after the questions, but before the end of the hour, we will be showing you the new user interface for the risk analysis service. Just a 5-minute tour. We're excited to share this with you because it's a major advance for the product. So at this time, I'd like to turn it over to Tom Cronin from AFS, and thank you all for joining us today.
So thanks, Stephen, and thanks everyone on the line today for accommodating our switch to Wednesday. And I wanted to briefly explain why. Tomorrow, I'm off to Virginia for my niece's wedding. And 6 months ago, we weren't sure this was going to be possible. But now we're all vaccinated, and the only concern we have is the weather, as the wedding is actually outside at a farm. And now you're probably thinking, what does this have to do with non-accruals and special mention loans? And if you give me a second, I'll tie my optimism and some recent economic performance, some good news, as we get into these April results. So today our data source is the Risk Analysis Service, or RAS as we call it. With RAS, we gather performance data from banks every month. We process and verify now about $1 trillion in exposure and 875,000 loans. And then we return that data to each bank member via a workstation. Member banks can then compare their data and results to the select group of peers by segments such as collateral, industry, and deal size. So we're going to examine the C&I portfolio on the next pages. If you were with us last month, you noticed we were on CRE first, but now we're going to start with C&I. And by way of definition, C&I are business purpose loans made to companies with annual sales north of $1 million. And these loans are manually underwritten and also manually risk rated. And loans secured by owner-occupied properties are included in the C&I portfolio. So here's our loan performance trend chart showing the results of the following measures. Non-accrual in the red, 30 to 59 days past due in the blue, 60 to 89 days past due in the yellow, and 90 plus past days in the green. And we're showing these results for each period, starting with 3Q03 when RAS started. And I mentioned my travel plans and my optimism, and I also wanted to touch on some recent economic news. For instance, the change in GDP for the first quarter was up 6.4%. New home sales for March were a little over a million units seasonally adjusted. Consumer spending 1Q21 versus 4Q20 was up 10.7%. And the industrial production index for April was up 0.7%. So we have all this good news and optimism throughout. And yet, if you look at the red line on this chart, that's the line for non-accruals, the economic good news has not translated into good news for our performance measures. April's non-accrual rate was 0.94%, down just a single basis points from March. And we've seen very little movement since August of 2020, hovering close to 1% for about 9 months now. So I thought it'd be worthwhile to examine the non-accruals in more detail, and we'll leave the delinquencies to next month. On this chart, we've pulled the non-accrual rate as of April 2021 for each of the 2-digit NAICS. And you can see that there are 5 NAICS codes that are close to or above 2%, which is double the overall average. Starting on the left, 21, mining, oil and gas, is by far the worst performance. Its non-accrual rate is now at 7.2%. Moving to the right, you see 71 arts and 72 accommodation are the next highest, followed by 56 admin, moving again back now to the left, and 45 retail. 92 public admin on the far right is the best, now at 0.09%, trailed by 52 finance at 0.14 and 49 transportation at 0.16. So on the previous slide, we saw the current non-accrual rate for each 2-digit NAICS. Here we take a look at the change in non-accrual rate for each 2-digit NAICS, comparing April 2021 versus April of 2020. And a positive result here, or as you see in the red, means the non-accrual rate climbed. And we again have 5 industries, very similar to what we just saw, with the highest levels, with one exception. So 21, mining, oil and gas, increased 240 basis points. 71 arts increased 218 basis points. 72 accommodation increased 120 basis points. 55 management, and this is the exception, was up 98 basis points, and 45 retail was up 88 basis points. So we can refer to these 5 industries as the industries most impacted by COVID and the restrictions applied to mitigate the spread of COVID. And we're going to take a closer look at 3 of these sectors. So we're not going to examine 21 mining and oil and gas today. Non-accruals for this sector have increased over the past year, but in discussions with several of the RAS banks, the feeling is that oil and gas had trouble before COVID. We're also going to pass on looking at 55 management, as that sector is not as large in terms of outstandings as some of the other sectors. So we really didn't feel it was appropriate to look at that. So on the next few pages, we're going to drop to the 4th level of the NAICS code for 71 arts, 72 accommodation, and 45 retail. So here are the non-accrual rates for the arts subsectors as of April 2021. Amusement parks are just a little below 9%. And then other amusement and recreation is at 6.4%. And examples of the other recreation here are fitness centers and ski facilities. And one more item to point out, 7111 on the far left, performing arts companies are at 2.4% non-accrual. And subsectors with minimal levels of non-accruals are museums and spectator sports and agents and independent artists. So you can see even within a single NAICS categories, there are varying levels of impact, COVID impact. So now we'll move on to 72. And 72 accommodation is officially titled accommodation and food services. But as you can see here, currently for loans classified as C&I, the largest percent of the non-accruals is on the food side. The non-accrual rate for drinking places is at 9.5%. Full service restaurants, right in the middle, is at 4.2%. Special food services is at 3.7%. And the last on the far right, restaurant, is at 3.55%. And just a comment on that, the 7225, most of the non-accruals for that particular subsector are actually for full service restaurants, about 60% of it. So if we add, say, 2% of that to 7221 full service, we'd get a non-accrual rate close to 6% for full service. So drinking places would be at 9.5% and full service would be at 6%. And clearly those two are the most impacted when you talk about accommodation and food services. And the last sector is 45 retail. And within 45 retail, there are 13 subsectors, and direct selling establishments on the far right have a non-accrual level of 7.4%. And examples of some of the direct sellers are in-house sales such as party plans or coffee break supply providers or bottled water providers. And the last two of which have been dramatically impacted by office shutdowns. We're also seeing above market averages, non-accrual averages for general merchandisers, which are things like dollar stores, auto supply, home furnishings. General merchandisers are at 2.7%. Vending machine operators are at 1.3. Sporting goods and hobbies are at 1.27 on the far left. And electronic and mail order are at 1.02. And surprisingly, the one that really baffled me here is the 4512 bookstores. That's at 0% non-accrual. So to recap for these three, the subsectors with the highest level of non-accruals and subsectors that were impacted significantly by the COVID restrictions were amusement parks, fitness centers, and performing arts companies, drinking places and full service restaurants, and direct sellers. So if you joined us before, you notice this is one of our standard charts, and it shows the detailed trend for loans classified as criticized or categorized as criticized, and shows the credit quality. And the details are following. Special mention is in blue, substandard is yellow, doubtful is green, and loss is red. And a quick comment about risk ratings in RAS and how we arrive at this. So for each new bank, we map their native borrower risk ratings to the RMA 10-point scale. And on that scale, 1 through 6 is pass, and 7 through 10 is criticized, as you see on this screen here. And at the height of the recession in the 2009, we reached a service high of 21.2%, and that was actually in the third quarter of 2009. We dropped to the mid-range, the mid 6% range in late 2014. And then energy issues moved the percent criticized back up to 7.75 in 2006. But by early 2020, we actually saw service level lows in the 5.5 to 5.8 range. Then you can see the impact of the COVID restrictions came into play, and we saw dramatic upticks in April, May, and June of 2020, topping out at 8.6 in September of 2020. But since that time, the percent criticized has mostly improved. We had a small bump last month, but we're down almost 30 basis points this month. And I did want to mention that while we saw an overall improvement and a substantial drop for special mention, which is the blue part of the bar, the percent substandard actually increased this month and is now back to levels we last saw in 2016. A year back, substandard was at 211. Now it's at 2.92%. And so we're going to monitor this going forward throughout 2021 to see if this is really a turn for the worse. So here we have the overall percent criticized for each 2-digit NAICS code. And there are 7 industries that are at or above 10%. And this time I'm going to try to stay going left to right. I realize on a couple of the previous charts I was bouncing around, so I'll stay left to right this time. You have, again, above 10%, 11 ag, 21 mining, oil and gas, 45 retail, 48 transportation, 53 real estate, which is actually just a tad below 10, but I rounded it up, 71 arts, and 72 accommodation. And we saw 6 of these coming in as above average when we were analyzing the non-accruals. Only 48 does not have an above average non-accrual rate. And we've said this before, charts like this are a clear representation of the limited impact that the COVID restrictions had. So on the next 3 charts, we're going to examine loan growth or changes in balances. This particular chart looks at the monthly differences this year in loan outstandings for each bank. If a bank had an increase in its outstandings, that gets tagged and moved into the green section of a column. A drop in outstandings moves it into the red. And earlier this year, most banks were experiencing declining balances. But for the last 2 months, it's been about 50-50, maybe a little bit better. And I would mention that regardless of the increase or decrease, particularly in the May to April timeframe, the changes have been very small in the 1% plus or minus range. So there's really not a lot of movement or loan growth either way. Excuse me. So here's a slightly different look at growth. This time we've pulled all the loans that were originated in April of 2021 for each 2-digit NAICS. And the sectors are arranged by their new loan amount. The bigger boxes represent industries with more new loans. So for April, new loans for 52 finance and insurance led the way. Actually, 32% of the new loans made in April were for companies tagged as 52 finance and insurance. And no other sector is even close. The next one, 42 wholesale, is at 8%, and so is 51 information, also at 8%. You'll also see a little bit further to the right, 44 retail came in at 4.2%. And I just want to mention that that was almost entirely for new car floor planning and auto parts stores, not the typical department stores type of retail. And back again on 52, most of the new loans there were for miscellaneous financial investments, such as clearinghouse, quotation services, and stock transfer agencies. And one last look, one last chart on C&I and new loans. And I want to reference first the April 2021 Senior Loan Officer Opinion Survey on bank lending practices reported by the Fed, where the respondents indicated that they had eased their standards on C&I loans. They held standards as is for CRE, and all this in light of weak demand for C&I and mixed demand for CRE. So we wanted to see if the RAS data supported these responses. And here we're looking at the risk rating mix for C&I loans originated in April of 2020, which is the blue, and C&I loans originated in April of 2021, which is the red. And from what we're seeing here, the change, the large increase in the percent of new loans rated 5 seems to support the response of the senior lenders. So for April of 20, 52% of the new loans were rated 1 through 4, which are the best categories. But by April of 2021, only 35% of the new loans were rated 1 through 4. Average and low pass new loans represent 63% of the total for new loans for April 2021. So these results support the Fed survey, and it appears in the face of weak demand, banks have begun to chase lower quality assets. Now we're going to move on to the CRE results and a quick definition before we look at the charts. CRE loans are made where the primary repayment of the loan comes from renting or leasing the property. And these loans are often referred to as investor owned. And we'll open our CRE review with the trend and performance chart. Now we started breaking out CRE results in late 2010. And if you look to the far left on this chart, you can see how bad CRE was coming out of the recession. And by way of comparison, non-accruals as of 3Q10, so that's the red line, were only 3% for C&I at 3Q10 versus the 9% you see here. So CRE loans were 3 times as bad as C&I loans. But with the exception of a brief blip upward in 2011, the non-accrual rate for CRE loans improved substantially since 2010. And we hit a service low of 0.28% in March of 2020. Then the impact of COVID pushed up the non-accrual level to 1.28 as of January 2021. And for April, we're now at 1.15%. Delinquencies, the green, blue, and yellow lines, have been more volatile than before, but altogether, they've basically been stable for the last 5 months. So here we have the percent non-accruing for each of the top 8 property types. And I based the top 8 on outstandings. And we're showing the trend over just the past year. And there's one obvious result here, and that is the red line, which tracks the trend in non-accruals for lodging. A year ago, non-accruals for lodging were at 0.13%. By the end of 2020, the level had reached 8%, and now for April has climbed again to 9.18%. And we haven't seen non-accrual levels this high in over 10 years. And to me, just as interesting, but not as obvious, is the trend for the other property types. With the exception of the multifamily, residential, and office, which really haven't moved very much at all. You see those in the green and the purple line at the bottom. The other property types, such as healthcare, industrial, mixed use, and retail, all spiked up in December 2021 or January 2021, but since then have remained at that level. Something we've seen the same with at C&I. And again, the only one that's really deteriorating now or continuing to deteriorate is lodging. So here, this is a growth chart, and it's the same approach here as what we did for C&I. It's a month-to-month comparison of the outstanding balances. And CRE balances had been in a decline, as you can see from the red, from January to February and February to March. But for April, we finally saw more banks increase their outstandings. But similar to what we saw for C&I, most of those changes were very small. So even though this appears to say CRE loans are growing, they're really not growing that much. And now we're going to look at new loans by property type. We did this, if you remember, similar chart for C&I by industry, but here is property type. And these again are all loans that were originated in the month of April 2021. 27% of the new loans were for residential properties, continuing a trend that we've seen throughout this year. Multifamily and industrial properties comprise just a little less than 20% of all the new loans. And just one other comment, in the lower right, you see the little gray box. That's lodging. And if you were with us last year, you remember that lodging was actually increasing, and we had loans in the hundreds of millions of dollars. But for April, we actually had loans, new lodging loans, amounting to just a little over $2 million. So again, this is a new loan chart. And we have a field in RAS called purpose. And as you can see here, the 3 purposes are construction, mini-perm, and permanent. And mini-perm we classify as less than 5 years. Permanent is loans that are greater than 5 years. And historically, construction loans have been considered more risky than permanent loans. As with a construction loan, you have building risk and then leasing risk. And most permanent loans are usually fully functioning properties and mostly fully leased. So the Fed survey said the overall standards were not changed, but standard for construction loans were tightened. And we expected a tightening would result in a decline in any new loans for construction, but our data shows the opposite. And this actually bucks a trend that we've been seeing since the recession, where most of the commercial real estate loans made by banks were for permanent purposes. So in the first 4 months of 2021, new construction loans have been greater than mini perms and permanents. And we're going to keep monitoring this. And we actually reached out to some of the banks to understand what's happening and why we're seeing this. And one last look, and this is again looking at new loans, this time showing the risk rating distribution for April 2020 in the blue and April 2021 in the red. And you'll recall that the Fed survey had indicated that unlike C&I, CRE lending standards were not eased in the face of mixed demand. And to me, this chart seems to support that statement. For April 2020, 58% of the new loans were rated average or low pass, and that's a 5 or a 6. For April 2021, only 44% of the new loans were rated average or low pass. Now, as you can see by the red columns, more better than average new loans are being made, perhaps a flight to quality. So that concludes our results. And a quick summary. Overall, and once again, we saw this last month, very little movement in the performance measures for both C&I and CRE, despite the general outlook and of optimism and the positive economic news. The non-accrual rate just doesn't seem to be moving. The risk rating mix for new C&I loans definitely indicates a more risky portfolio. And again, there's a very limited number of industry subsectors that are still performing worse than average. Those being oil and gas, lodging, amusement parks, direct selling, and drinking establishments. So Stephen, I'll turn it back to you.
Great, thanks, Tom. It's always amazing. Every month the story changes a little bit here, and this April is no exception on that. So just a reminder to everybody, the Q&A button should be at the bottom of your Zoom screen, and you can start loading up your questions there. And it's, I think, a nice feature of this community that we've built, that people feel free to ask questions on it. And we've got Tom and Jeremy, who are really experts at the data and are talking to the banks and have some good insights on that. So this is the time to be queuing those up. We do have one, Tom, that's already in there from Marlo. So thank you, Marlo. Construction loans. How are acquisition renovation loans considered for these reports? Is the purchase note included in the construction bucket or only funds dedicated to renovation of a property?
So when we look at the purposes, we're basing it on the term. So it would all depend upon how you'd structured these loans. I've actually seen, so the acquisition and renovation piece usually goes in as a construction loan and then gets termed out. So that the overall purpose might be acquisition and renovation, but the initial loan is a construction, and then it ends up actually as a term loan.
Gotcha, thank you. Here's a question back to, I think, your comment on the most recent Fed survey, but the question was from, well, anonymous, I guess. How was C&I lending eased?
So actually, it was it wasn't the lending itself that was eased, as it was the credit standards. So that the lending requirements, so to speak, were actually, that was what has been eased.
Yep. So we should see other balances coming in later, and possibly some changes in delinquencies.
Yeah, and Tom, this is Jeremy. We also saw for investment grade loans, at least, spreads narrow. So another way that perhaps standards eased a little bit over the last few months.
Perfect. Thank you, Jeremy. All right, question from Colin. Do you have information on allowance levels for the loans in your data set as in the average 6-rated C&I loan in our database has X% reserves?
We do not have that information at this time. That is not one of the fields that we have been asking for.
Gotcha. Thank you, Tom. All right. Well, we're a little light on questions today. This is the time to do it, folks. I'm going to give it just a minute or two more, and it's okay if you don't have questions, but I'll keep it going there for a second. All right, here's one from Anna. Where do you see interest rates going and when? Your crystal ball, is that polished up, Tom?
So that's actually a Jeremy question. I'll toss that one over to him.
Yeah, if the question is, if we're talking about actual commercial loan pricing, not monetary or policy rates, but rates charged on commercial loans, they've plateaued over the last few months. We actually, in a recent webinar, looked at pricing trends. I don't see them trending upwards anytime soon. Like I said, for spreads at least, we did see a little bit of a narrowing or an easing for the better rated credits. But I'd say at least for the near term outlook, I don't see pricing on commercial loans changing that dramatically.
Jeremy, are you seeing, just longer term, is competition pushing spreads in any direction?
Yeah, that's a great question, Steve. I know a few years back, that was definitely the story that we had an expression, one banker told us that a new loan is really one bank's loss renewal. That was the environment a few years ago, and that environment definitely was depressing commercial loan pricing. I'd say now that competition not quite as intense as it had been. It's starting to heat up a little bit again due to the economy recovering. But again, I really don't see pricing changing all that much in the near term, although for the very best credits, we did see spreads narrow.
Great. Here's a question from Mike. Are banks still releasing reserves?
So the answer to that is definitely yes. We talked a little bit about this when we were preparing the bulletin. In light of the fact that what we saw earlier, the non-accruals haven't moved very much. The reserves are being released at a record level. We were wondering whether the reserves had been too high to begin with, or whether they were being released too early, or some combination of that. And then just today, matter of fact, we were talking about it, and my colleague Doug Skinner pointed out to me a graph that we had that shows the reserves being released, but they're still higher than they were pre-COVID. So the answer to that is yes, they're being released. And the outstanding question is it too soon, or were they too high to begin with?
Mm-hmm.
Yeah, and Tom, just building on that, I believe, if I'm not mistaken, this was the first quarter in history where there was a negative provisioning for the industry as a whole.
Yes.
Wow. Here's a question from John. The increase reflected in construction lending April 2021, is that primarily attributed to residential construction?
So John, it's a combination of residential, multifamily, and industrial. Those three. And really the only one of those is the multifamily. In the past, it seemed banks were doing a lot of term lending for multifamily. Now they're getting more involved in the construction process. You've always been involved in the construction process for residential and industrial, but now multifamily is coming in there as well.
Question from Zach. Are lenders locking in longer fixed terms to win deals?
So go ahead, Jeremy.
Yeah, I don't know off the top of my head, Zach. I know, again, going back a few years ago, that was definitely the trend where we saw quite a bit of growth in new volume with a greater than 10-year duration. Recently, with the term distribution, looks like I don't know. I believe the last time I checked, it was not increasing all that much, but I can't say that for sure. But a few years ago, that was definitely the trend.
Danielle has a question. Any insight into how the economy will perform in the coming months, both C&I and CRE, given the good story as per the recent results like growth in GDP, et cetera?
So everything that I've seen says that the economy is doing well and is going to do well, and that the predictions for the rest of this year are very favorable. The possible headwinds, I guess you'd say, to that are the vaccination, and then actually your second question, which is about inflation. Those are the concerns I think people have.
Good. Thank you, Tom. Sarah asks, any insight on what's driving the increase in C&I finance and insurance lending?
So I'm trying to figure out how many things I could put in one. So a lot of what's in there, it wasn't in there this month, but what has been in there in the past is loans to funds that are investing in leveraged transactions. And we've sort of joked, it's kind of been the way the banks have gotten around specifically saying that they're investing in HLTs. So a lot of the F&I are funds and securities that are, commercial CLOs that are would be marginal on a bank's book, but look okay because it says it's to an F&I company. And then the other thing, a lot of those loans also, not all of them, but a large majority of these are participations, which if you stick around for the demo, I might actually be able to show you participations have jumped through the roof in the last year or so. And that seems to be one of the things that gets participated out quite a bit.
Yeah, and what's fascinating there too, Tom, kind of thinking back to your industry chart, is that if you look at the composition of C&I volume, what it looks like now versus say a decade ago, it's very different, where you see a lot more concentrated in sectors like finance and insurance. It's really mirrored too, if you were to look at GDP trends by industry, the shift away from sectors like manufacturing towards information technology and finance and insurance. The shift in C&I volume has mirrored that broader economic shift as well. So it's a really fascinating trend, and one that we'll continue to monitor in these webcasts.
Ryan wonders if there's longer term trend data for the figures on slide 18 and specifically slide 12. Do you have new loan mix by industry or property type for the past 6 and 36 months?
So the answer to that is yes, Ryan. And if you would, I think our emails are attached to this document. If you would shoot me an email with that question, I can respond to you with some information. And if anybody else on the call would like that information, feel free to also shoot me an email and say, you want the same information that Ryan's getting, and we can send you some stuff on that.
Terrific. Thanks, Tom. Yeah, Tom, I wonder if you could just advance to the page that has your email address.
Okay.
And while he's doing that, just last call for questions. And happy to take them. We have the time for it, but if not, I may transition.
Okay, I'm going to stop sharing and move.
Okay. All right, terrific. Well, while Tom's actually setting up now for the next segment, which we're going to show you guys just a real short nickel tour of the new user interface. And I want to give some context for all this. So those of you that have joined today and may have joined religiously over the past year plus or longer know that we are giving you the highlights when it comes to the monthly RAS webinars, things that we've dug in mostly at the macro level. But our subscribers have access to their very own workstation where they can look at themselves versus a peer group that they decide or the rest of the market. Far more detailed analysis, as you might imagine. The workstation, however, that they've been working on is, of a vintage that makes it difficult compared to the power of today's tools. So while it's very robust and gets to the answers, it does require a bit of a learning curve. So as we went about thinking about how we wanted to invest in the risk analysis service going forward and how to best serve the market needs, one of the things that really popped up was to modernize the business intelligence user interface that sits on top of all of this valuable monthly data. So that's, if you choose to stay on, and you don't have to stay on, for the next 5 or 6 minutes, Tom's going to take you through a couple use cases, and you'll get a feel for how that looks.
I'm just about there, Stephen.
Okay. And while you're still getting on there, I can preview. We've had a chance to share this with some of the subscribers already, as it's becoming available to them, and it's been received very well. And a lot of people are excited about it. And I predict that there'll be far more users that will want to, do their own slicing and dicing and drilling into things as they're able to do it, I think, easier than the previous user interface.
All right. So I'm going to share. All right. Can you see the screen now?
Yeah, it's coming through clear.
Okay. So again, this is just going to be 5 minutes if you're still with us. So what we've created are 3 web pages. The first one in the upper left is called Executive Summary. It gives you a real quick glance of where do I have problems or opportunities. The second web page is called Early Warning, Problem Management. It gives you a little more detail, and I'm going to show you some of that later. The third one is Concentrations. Enables you, just as it says, identify where you have concentrations and where you might actually be an outlier. And then within the executive summary, so going back to the executive summary, you have 5 tiles. One is an outstanding, 2 are performance, and 2 are credit quality. It gives you your bank. So the peer bank, your bank is in the blue, the peers, the self-selected peer group, and then the market, which is actually every bank minus yourself. And you get to see over the course of time where you have been versus everybody else. And then it also down here at the bottom on the 3 charts at the bottom, you see the more recent time period. So this one on the far left is March. February is in the middle. Again, your bank versus your peers versus the entire market. And then the past due for December, the end of the last year. And just to kind of give you an idea of how this is used. So if I switch to non-accruing, and so let me go back and look at past dues. So if I stay with this, what we've seen people do, and Stephen mentioned, we're talking to people now who have seen this before. We had a particular bank that was interested in what they had loans in 48 transportation. They wanted to see what was going on with 48 transportation because they were experiencing some issues and the rest of the greater than the rest of the bank. And so you can see here, if you remember, their past due ratio overall was in the 0.58, I think it was, and they were better than the market. But here, they're in the blue. So their past dues, and this is for 48 transportation, they're just shy of 1%. They're at 0.95. Their peer group is at 0.2, and the market is at 0.15. So this indicated to them that not only are they having problems with a particular industry, but the rest of the market is not. So that would say to them, they're doing something wrong. It's not that the industry is bad. The industry itself is performing, halfway decent. It's whatever they're doing, however their credit policy is, they're having problems. They're having issues with that. Then you can take that same idea and look over here at the early warning tab. And again, the early warning is going to give you some more information, more detail on what's available or what's causing you problems. And again, I always tend to focus on the problems, but it's opportunities as well. So again, we're looking at past dues, and we wanted to look at 48 transportation. And you can see, so 48 transportation is what we looked at. Here are the gauges. So for past dues, the overall past due is kind of in the yellow. on this gauge. And these gauges are based on the averages, the 18-year averages. We took a look at the quartiles. And so green means you're in the best quartile, red's the worst, and the yellow is in the middle. So you can see for past dues, you're right about the middle where you have been historically. There's a dollar figure here, this first chart in the upper left. The chart on the upper right is the percent. And then you have the charts that actually, I've said this before, and I'm sure I'll keep saying it. This is the chart I like the best, the worst performing industries. This shows me what I have to go after, where I'm having my problems. So accommodation is the highest for this particular bank. And here you see transportation again, down here in the middle. Pardon me. But if you want to look at, so that's looking at past dues. We've mentioned non-accruals, but you can also look at credit quality, and you can do that by looking at criticized loans. And again, it comes in with the dollars and the percent. And you can see here now, the bank is a little bit above average. 48 is the second worst in there. Let's try to see what that number is. So in the 30% range. So it gives you, so you know from a performance standpoint, you're having problems with 48. And from a criticized credit quality standpoint, you're having problems with 48. And it's actually far above the market in what you're seeing. And then the last tab is concentrations. And again, you have some selections to make. And what I'm going to look at, again, going back to the questions we had or the statements from the Fed that people were loosening credit standards. One of the ones I always look at, if I can get it correctly, here we go, is collateral. And I always like to look at unsecured because unsecured tend to be, even though they're for better customers or tend to be for better customers, frequently they go bad. And you can see that the unsecured lending, and again, this is for March, for your bank, you're almost at 30%. You're way above the peers and you're significantly above the market. And then what you're low on are working assets. So your working assets are at 19% of your portfolio, your peer group's at 38, and the market's at 34. So from a structure standpoint and a security standpoint, you're way behind the market. You're making loans without much security. And then one other thing I'll mention before I stop, one of the unintended consequences of looking at data is that you see things that aren't properly coded. And I wanted to call your attention to this column here called unknown. And so that means that this is a loan that had collateral without a collateral code. And so one of the things that we found is banks come in and look at that and say, oh, that should have been commercial real estate. It should have been marketable securities. And it's kind of a quality assurance step that you can do by using this data as well. So Stephen, that was kind of the quick 5-minute tour.
Terrific. Thank you, Tom. Very good. So why don't we wrap it up there? If there were any more questions that come through, of course, we have a few minutes on that, but I don't see any, Tom. So I think what we'll do is we will do our wrap up. So first of all, thank you to all the participants. I know you've got lots of choices to get your information, and we appreciate you joining us for this monthly webinar. And particular thanks to both Tom and Jeremy, all the hard work that goes into not only this webinar, but the bulletin and all the other extra insights that you provide. So we'd like to have you guys join us at our next session, which is scheduled for June 24th at 1 p.m. And if you remember from the previous slide that Tom had up, we are going to have a demonstration webinar. It's scheduled for June 15th, also at 1 p.m. Eastern. And we'd love to have you join there. You can register at the rmahq.org website in the events category. And you can join us for a more in-depth demonstration, and we'll be able to take very specific questions on the new user interface. So as this now concludes the webinar, I'd encourage you to take a moment to fill out the survey that comes after the webinar closes. we use that to help make this webinar more interactive and meet your needs better. So with that, I'll just say thank you and wish everybody a nice day.
Thank you.